Have you ever thought about how much our beliefs can kind of like bend reality, especially when it comes to money in the markets?
Yeah, it's kind of wild, right? Like, what we believe can actually change what happens.
Exactly. So someone sent us in this really thought-provoking material on George Soros and his book, The Alchemy of Finance. And we just had to do a deep dive on this.
Absolutely. Soros is a legendary investor, but this goes beyond just investment strategies.
Right. This is about understanding a much deeper dynamic, this interplay between our perceptions and how the market actually behaves. It's about the forces at work behind the scenes, so to speak.
And at the heart of it is Soros's big idea, his theory of reflexivity.
Okay, reflexivity. That sounds a bit complex. Break that down for us a little.
In a nutshell, it's the idea that our thoughts about the market, like what we expect to happen, don't just float around in our heads. They actually influence what happens in the market. And then how the market reacts feeds back into our thinking, shaping what we believe next.
So it's a two-way street. Our beliefs influence the market, and then the market influences our beliefs.
Exactly. It's like this constant feedback loop.
And that makes things pretty messy, right? It challenges those classic economic theories that say markets naturally tend towards like perfect balance and stability.
Yeah, Soros really throws a wrench in those theories. He basically says, forget about perfect balance, folks. The market is inherently unstable.
Interesting. So today we're going to explore this whole idea of reflexivity, these feedback loops that shape the markets, how speculative bubbles form, why understanding the guts of the market is so important, the link between what we think and what actually happens, the risks involved, and oh yeah, how our psychology as investors plays a huge role in all of this.
Sounds like a plan?
Okay, so back to reflexivity. It has a couple of main parts, right?
Yep, two key parts. First, like we said, our thoughts about a situation can actually change that situation. Take a company, for example. If everyone suddenly starts thinking it's going to be a huge success, investors pile in, the stock price shoots up, and all that new money and attention can actually help the company become more successful.
So just the belief that something's going to happen can kind of make it happen.
Yeah, kind of like a self-fulfilling prophecy. But here's the second part. The changing situation then circles back and changes how people think.
So if that company's stock keeps going up, investors get even more confident, right? Like, see, we were right.
Exactly. It creates this feedback loop. But Soros also says that our understanding of what's going on will always be kind of fuzzy.
Because reality is always changing, influenced by what everyone's thinking and doing.
Exactly. And that's why Soros says those traditional economic models that predict perfect balance in the market, they're kind of like fairy tales.
Makes sense. So how do these feedback loops actually play out in the market? I mean, what does that look like in practice?
Okay, imagine a bunch of, let's say, cryptocurrency traders. They believe the price of a certain coin is going to skyrocket, so they all start buying it.
Uh-huh.
Their combined buying pushes the price up, right? And that price increase seems to confirm their initial belief, so they buy even more. And then other people jump on the bandwagon.
So it's like they're creating the very thing they predicted would happen.
Right. And as the price goes up and up, people can kind of lose sight of the coin's actual value. They get caught up in the hype.
Ah, that's how bubbles form.
Precisely. It's a classic example of reflexivity. Prices keep rising, fueled by the expectation that they'll keep rising, even if there's no real justification for it.
And then at some point, the bubble bursts.
Yep. Eventually the hype fades, people start selling, and the price crashes.
Okay, now Soros also talks about this thing called the human uncertainty principle. What's that all about?
It's like this. Trying to predict what humans will do is way more uncertain than trying to predict, say, how the planets move.
Because we're not robots. We're driven by emotions, biases, all sorts of things we don't even fully understand ourselves.
Right. Soros says that human behavior just adds a whole extra layer of uncertainty, making it almost impossible to predict what's going to happen in the market with any real accuracy.
So we're kind of stumbling around in the dark, making decisions based on incomplete information and a whole lot of guesswork.
Yeah, pretty much. And that makes the whole idea of perfectly rational investors who always act in their own best interests, well, that's kind of wishful thinking.
Okay, so what about those traditional approaches to financial analysis, like fundamental analysis and technical analysis? How does Soros view those?
He's pretty skeptical of both. He says that fundamental analysis, which is all about looking at a company's financial health and its intrinsic value, it often misses a crucial point,
Which is?
that stock prices can actually affect the company itself.
Okay, yeah, I see what you mean. Like, if a company's stock tanks, it can hurt their reputation, make it harder for them to raise money, and so on.
Exactly. And technical analysis, which is about trying to predict future price movements based on past patterns, well, Soros doesn't think much of that either.
Interesting. So he's not a fan of those classic tools of the trade.
Nope, he's much more interested in understanding the bigger picture, the psychological and reflexive dynamics that are driving the market.
Makes sense. And this skepticism, as I understand it, extends to those core economic principles of rational expectations and efficient markets.
Absolutely. Remember, rational expectations basically says that investors are rational and their expectations about the future are always accurate. An efficient market says that all available information is already reflected in current prices.
Yeah, yeah.
Well, Soros says, hold on a minute, that's not how it works in the real world.
Because people are not always rational. We're influenced by all sorts of biases, emotions, hard mentality, you name it.
Right, and that's why markets don't always behave the way those theories predict.
Okay, so Soros is all about challenging those traditional assumptions, and this leads to another crucial point, which is how our biases, our irrationality, actually affect those so-called fundamentals.
Yeah, so it's not just that our biases distort our view of reality, they can actually change reality.
How so?
Well, imagine everyone gets super excited about, let's say, electric vehicles. They pour money into EV companies, driving up stock prices, even if those companies aren't actually making that much money yet.
Right, so the hype, the belief, kind of creates its own reality.
Exactly, and all that investment can actually help those companies grow and innovate, even if the initial hype was a bit overblown.
So the belief, even if it's not entirely based on facts, can still have a real-world impact.
Yep, and that's when reflexivity really kicks in, when it starts to shape the fundamentals, the underlying reality of the market.
Fascinating. Now, the summary also briefly mentions this concept of open society in relation to finance. What's that all about?
Okay, so the summary doesn't dive deep into a full-blown open society theory of finance, but you can kind of see the connection, right? Like, an open society is all about the free flow of information and ideas and everyone having a voice.
Yeah, yeah.
Well, financial markets are kind of like that too, in a way. They're all these different players with their own perspectives and interpretations of what's going on.
And they're constantly interacting, buying and selling, reacting to each other, just like people in an open society engaging in debates and exchanging ideas.
Right. It's a messy, dynamic system with no single centralized authority controlling everything.
Makes sense. Now, let's talk about risk. Given all this uncertainty and instability, how does Soros view risk-taking and risk management?
Well, he sees risk as an inherent part of the market. Remember, he says markets tend towards instability, not equilibrium. So there's always the potential for things to go wrong.
And that's where those boom and bust cycles come in, right?
Exactly. Those cycles are like a built-in feature of the market. And Soros uses the example of banks in the 1970s.
What happened there?
But these banks were flush with cash from oil-producing countries, and they were convinced the good times would keep rolling. So they started lending more and more recklessly.
Until the whole thing blew up.
Yep, classic boom and bust. And Soros' point is that this kind of thing happens all the time. It's just the nature of the beast.
Understanding and managing risk is absolutely crucial.
Absolutely. Because if you don't, you're just setting yourself up for a fall.
Okay, the summary also critiques this idea of market fundamentalism. What's that all about?
So market fundamentalists basically believe that free markets are the best way to allocate resources and that they're inherently good for society.
But Soros doesn't buy that, right?
Nope. He says markets are amoral. Their main driving force is profit, and that can lead to all sorts of problems.
Like,
Well, take art, for example. Market fundamentalists would say that the price of a piece of art is a reflection of its value.
but Soros would argue that the price might just reflect how much rich people are willing to pay for it, not of its actual artistic merit.
Exactly. So he's concerned that this focus on profit can distort our values and lead us to make decisions that aren't necessarily good for society as a whole.
That's a pretty provocative thought. Okay, last but not least, the summary briefly touches on the international financial system. What's the key takeaway there?
It basically highlights the power imbalance between center countries like the U.S. and peripheral countries.
So the haves and the have-nots.
Yeah, kind of like that. Center countries can borrow money in their own currency, which gives them more flexibility to manage their economies.
Whereas peripheral countries often have to borrow in foreign currencies, making them more vulnerable to economic shocks.
Right. And Soros argues that this structure can actually perpetuate global inequality.
Okay, we've covered a lot of ground here. Let's try to sum up some of the key takeaways for you, our listener.
First off, this whole idea of reflexivity, it's a game changer. It means that our thoughts, our beliefs, actually influence how the market behaves.
So we're not just passive observers, we're active participants shaping the very reality we're trying to understand.
Exactly. And that leads to the second takeaway. Markets are inherently unstable. They're constantly in flux, driven by these feedback loops and our own human unpredictability.
Third takeaway, those traditional economic models that predict perfect balance and rationality, they're not always a good guide to the real world.
Nope, they often miss the messy human element. And that brings us to the fourth takeaway. Our psychology, our biases, play a huge role in how we make financial decisions.
We're not always as rational as we think we are.
Not even close. And finally, the fifth takeaway. What happens in the market, those price movements, they don't always reflect true value or what's best for society as a whole.
So we need to be critical thinkers, not just blindly follow the herd or assume that the market always knows best.
Right. And hopefully, by understanding these concepts, you, our listener, can navigate the financial world with a little more wisdom and a little less risk.
It's about recognizing the power of perception, the influence of our beliefs, and the inherent uncertainty of the market.
Exactly. And it leaves us with a really interesting question to ponder. If our understanding influences reality in the financial world, what responsibility do we have in shaping that reality?
It's something to think about, for sure. Thanks for joining us on this deep dive into the mind of George Soros.
It's been a pleasure. Until next time.